Good morning and welcome to this Wednesday, August 24th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we've got futures relatively flat this morning, which I guess is good news. A lot of times in these pullbacks, we get a lot of the moves are at the opening bell. So I always feel pretty good if I'm bullish and I wake up and the futures aren't too red. So trying to get through this historical period, the 19th to the 25th, we got today and tomorrow to go. That 19th to the 25th period tends to be a little weaker. Just know that historically. It's still the week after options. We know we had a huge run up heading into options week. Then we had a lot of in the money call premium that we talked about all last week, and how that could have a negative impact on the market. We saw that, and that carries over into the next week. And of course, we saw that on Monday with the big down day after the selling on Friday as well. So I think the market is in a better position now from a risk reward standpoint on the long side. Doesn't guarantee that we're going higher. I just believe that, I'm of the mindset that we're resuming the secular bull market. There are plenty of others who disagree with me, believe that this is that what we've seen here over the course of the last 3 months, 2.5 months, has been nothing more than a bear market rally. I would strongly disagree with that, but time will tell who's right and who's not. But we have lost the 20-day moving average on the S&P, and we're going to get into all of that in just a couple of minutes. But first, I'm going to take everyone over to Earnings Beats. We've got a huge event coming up this week. So I want to make sure that everybody is aware of that. Hold on one second. All right. So if you go over to Earnings Beats, right at the top, we've got an event on Saturday morning. So that's just 3 days away. Where does the market go from here? And that's where I'm going to spend all of my time talking about what we've been through, where we're going, or where I think we're going based on all the signals I'm seeing as of that day. And I'll point out the good, the bad, the ugly, and then kind of try to put all the puzzle pieces together and come up with what I think is the likely direction of the market, how I think we get there and so forth over the next few months, maybe even into the early part of 2023. So that should be a really good, fun event. I know everyone's a little anxious, nervous about the market. We got September coming. September historically is the worst month for the S&P 500. That dates back to 1950. So we're talking about the last 7 decades. So what's going to happen not only in September, but, as we go into the fourth quarter of this year and then start a new year? Hopefully I've got some of those answers for you on Saturday. So if you haven't already registered, you need to register. So click on this and you'll find, learn more details about the event and then be able to sign up. Anyone who does register, if you're not already an Earnings Beats Digest subscriber, which is our free newsletter, we will add you. You can always unsubscribe. And if you want to just add yourself directly, you can scroll down, just put in your name, email address, hit that subscribe button. No credit card required. And like I said, you can unsubscribe at any time. 3 times a week newsletter, though, I think it's very educational and can provide some nice trading opportunities for those of you if you so desire to choose or desire to trade. All right, let's move on to what happened yesterday. So this was the action for Tuesday, August 23rd. Dow Jones Industrial Average finished down 154, S&P 500 down 9, NASDAQ flat, down 1/4 of 1 point. Mid caps basically flat, small caps down 1 point. So literally wasn't a whole lot of change. I mean, we did see a little bit of selling on the Dow, but otherwise rather muted action yesterday, which I actually found to be pretty bullish. And maybe, that's my, a lot of folks before this year, especially, thought I was perma bull. So maybe those are some of my perma bull colors coming out. And I'll admit, I am definitely biased on the bullish side over time because that's what history tells me to be. So I don't try to find issues in the market if the market's not telling me they're not there. If the market is saying it's full speed ahead, I'm not going to try and nitpick and find things that aren't working. or try and find reasons why the market shouldn't go up. I'm just going to let the market go up, and I'm hopefully going to be able to ride it. That's my theory. I'm not perma bull. Anybody who's followed me this year, I think now knows I'm not a perma bull. If I see things I don't like, I will get bearish. But it doesn't happen often because the market stays up more than it goes down. So hopefully that makes sense. Anyway, looking at sectors yesterday, energy was the big winner, up 3.6%. I don't know if you were watching, but crude oil prices yesterday jumped back above the 20-day EMA for the first time in a few months. So that was pretty encouraging for energy bulls. This move right here, you can see energy jumping up above recent highs. When crude oil prices are trending higher and now they're back above their 20-day, that's when energy tends to outperform. So this is, probably not a bad time to be trend trading the group. I would just keep an eye on the crude oil prices. And as long as they continue to trend higher, I'd be okay being in energy. But if they start to roll back over, fail to hold that 20-day moving average, then I think that's where you got to be careful. And you could get whipsawed. I mean, energy prices are volatile. Energy stocks are volatile. But at least in the short term, things have improved for energy. Materials had a pretty good day yesterday as well, up about 1%. Trying to hold on to that 20-day moving average. Also, the pullback recently came back to the breakout level. That was the high that we saw at the end of July, where we broke out in the second week of August, went back, tested that level right at the 20-day. So I think materials potentially are poised to make a little bit of a run here. Discretionary coming down right to the 20-day near this gap support area. I want to see the XLY move back up through the 20-day. We've now had our second consecutive close beneath the 20-day, even though it is just fractionally. Still would like to get back up, trade above the 20-day. I'll feel much, much better. I said at the open, I'm bullish. I think that yesterday's action was good. Well, what obviously would be better is for us to begin to trend back to the upside. So watch for a move above the 20-day on discretionary. I think that's going to be a key area. But discretionary did have a nice day on a relative basis yesterday. It gained more than 0.25%, which wasn't bad considering that the major indices were all lower. Real estate was your weak link, down 1.5%. Healthcare down 1.4%. This part's interesting simply because these are two defensive groups. So normally when the market is down, of course, it wasn't down a lot, but it was down. In order to be more bearish, I would want to see the offensive groups, the aggressive groups like discretionary underperforming. And we really didn't see much of that yesterday. So leaders to the downside, real estate and healthcare. 10-year Treasury yield update here, 3.08% is where we stand right now. That's up another 2 basis points. Clearly, the short term now has turned more into an uptrend. I would say the intermediate term is more sideways, more consolidation. And then the long term, coming off the lows that we saw back at the end of 2021, even much lower before that, you'd have to say the longer term, at least over the last year or two, has been more to the upside. I'm a believer that this is going to roll over eventually, and we're going to see lower interest rates. That's one of the things that I believe will help to trigger a rise in growth stocks in the fourth quarter, or at least the anticipation of lower interest rates. Right now, at least for the last few weeks, the bond market trying to prove me incorrect. I'm not going to read too much into 3 weeks, but if we were to go back up and take out that 348 high, that would be a shocker for me. I'm not expecting that. I would think we're going to stay 310, 312 and below. Possibly we get up to this high, 325. If you recall, 325 was the big number for 11 years. We could not get through 3.25% until we had those 2 days. And then it was just a quick little blip above the 3.25 and then right back down. And then you can see this reaction high back to 3.25. So 310, 312, this is going to be the first key area. My brows are going to raise a little bit if we get through there. 325 is going to be a much bigger level for me. If we get through 325, I'm going to be looking at a lot more puzzle pieces. Let me just put it that way. I'm not expecting the 10-year Treasury yield to go back through 325. We're getting ready to go into September. We got another Fed meeting coming up in September. So we'll see how the markets anticipate what the Fed might do. I said last month, I don't think they should raise anymore. Doesn't mean they won't. Sometimes the Fed likes to make a statement. They've been talking tough. The one thing they did change last month, though, is that they said they wanted to remain, or they wanted to become more data dependent in terms of their rate hikes, which was a new thing. And of course, last month's inflation reports, the PPI and the CPI, the headline numbers were both very, very weak. Actually, even the core numbers were weak. But I think it was the PPI headline number was supposed to come in up 0.3%. It was down 0.5%. So that's the start of maybe some of this data that could change and sway what the Fed is thinking about doing. Anyway, that's going to be an interesting developing story here over the next few weeks as we head toward the Fed meeting. All right. Let's move on to talking technically. Oh, we did have a couple of economic reports. I wanted to just go over those. So this morning, July durable goods came out. They were flat. The expectation was they were going to be up 0.5%, so a little weaker than expected. But if we strip out transports, the July durable goods actually rose 0.3%, which was higher than the expected 0.1. So I don't know, close to what was expected there. At 10 a.m., we're going to get July pending home sales. And if you remember, the June pending home sales were down 8.6%, massive drop. July is expected to drop another 2.5%. We just got new home sales that just came out way worse than expected, much weaker. So we're getting some not so great news there. That's another reason to kind of watch the 10-year Treasury yield, because this is kind of a benchmark for mortgage rates. So mortgage rates were starting to come down, but now we got this 10-year back on the rise again. We see a lot of these reports in the home building, home construction area not coming out quite the way we'd like to see them. This isn't going to help if rates keep going up. All right, moving on to talking technically in the S&P 500. Well, here's the second day below the 20-day moving average. What I can tell you is that while it's not unprecedented, it's a little bit unusual when you're coming out of what I believe is the cyclical bear market bottom and moving up out of that bottom. Normally this move up, and I'm not just talking about for 2 months, but usually the next 6 to 12 months coming out of a bottom of a cyclical bear market tends to be very, very, very strong. And this one was. That was a huge rally in a very short period of time. But most of the time, while the PPO is strong, we tend to see 20-day moving averages hold. Now, we're definitely breaking. If we were to, go down another 50 or 100 points, clearly, I mean, we would then be down closer to the 50-day, and the 20-day would be in our rearview mirror. Bouncing from here, you might just say, well, we had a little slight break, and then we went right back up. So I can kind of make a little bit more of a bullish argument from here than I'm going to be able to make from down here if we keep dropping. Now, one question that came in from a member is, what do I think of this PPO rolling over the S&P 500? If you're in an uptrend long enough, you're going to see the PPO roll over when prices come down. Early in the move, like back here, when we pulled back right here a little bit, you don't see much of a PPO drop. And the reason, you just crossed the center line, you're just starting to pick up momentum. Your 12 period and 26 period EMAs, which is what you use to calculate PPOs, it's the percentage difference in those two. You haven't really had a chance for them to run yet. I mean, if you go back and you just study history, this right here is not unusual at all when you get a pullback to the 20-day after an extended run. What I always look at is I'm looking at where was the PPO at the most recent price high. I look at the price highs, see the tops, and I look at where the PPO was. Is it still going up at each of those highs? If it is, then the momentum is strong at that high, meaning that when it pulls back, I generally look for the 20-day to provide support. So I don't care about this rolling over. And you might look back and say, well, yeah, but each of these other ones, when it rolled over, it went down. And I would answer and say, yeah, we were in a cyclical bear market. Comparing what I think is a resumption of a bull market to cyclical bear market rallies, you got apples and oranges. If you want to look at the PPO, go back and look when the market was rallying back in 2020, or even during periods 2021. That's going to be a much better period to look at versus this. This is what PPOs look like during cyclical bear markets. Now, again, you might say, well, this isn't a rally. This is still just a bear market rally. You're entitled to that opinion. I don't believe that. I think we bottomed. Is it a guarantee? Of course not. It's not a guarantee. I don't know for sure. I look at my signals. I try to put all the puzzle pieces together. There were a lot of reasons why these rallies would not work. Primarily, it was sentiment. Sentiment just simply was not where we needed it to be. Sentiment reset, in my opinion, at this low. I think we are good to go in terms of sentiment after that low. That was one of the reasons I called the bottom. 5-day moving average of the equity only put call ratio went above 0.80, which is marked 15 of the 18 major bottoms in this century. The other 3 were marked with CPE or CPCE readings of 0.75 or higher. So all 18 saw the equity only put call ratio, the 5-day moving average, go at least to 0.75. We weren't there on any of these highs, or excuse me, on any of these lows. That one we finally got there. So I think sentiment's reset, which is a big plus for the market. We had multiple trips on the VIX, by the way, up to upper 30s. I mean, some are waiting for 50, 45, 50, which you can hit from time to time. Many cyclical bear markets, though, only see the VIX move up into the 30s, sometimes around 30, 32. This happened to go up into the upper 30s. So I think sentiment all got reset. We got to the point where everybody's bearish. My gosh, I mean, reading some of these articles now after having 3 days of down. And by the way, most of the downside that we have now seen over the past week, probably 60 to 70% of it was at the opening bell. It wasn't even during the day selling. It was what I consider to be manipulation. There was good reason for it too. Last week, we had all that in the money call premium, right? What's one way to get rid of call premium really quickly? How about a gap down? Snap your fingers. You feel like, or, wiggle your nose, feel like you're on Bewitched or something, all of a sudden. I'm showing my age a little bit by the shows I remember. But literally, that's what the market makers do around option time. I feel like, they're like Samantha on Bewitched, or I Dream of Jeannie, just nod your head, boom, prices are down. Options, many of them go worthless. Nice little windfall for the market makers. Anyway, that right there, that's selling. I'm concerned because we're below the 20. I want to get back up above the 20, but we're not so far down below, and I don't see other signals that are making me overly nervous at this point. So I'm going to see how we rally, whether we rally and get back through that 20-day, especially as we get further and further away from option expiration Friday. All right, I want to talk a little bit about the banks. This is a weekly chart on the banks that goes back 20 years. All right, so here obviously was the financial crisis, 2007 to 2009. We lost 90% of the bank index. I don't know if you remember that. 600 down to probably about 60. 90% of the bank index gone in that period. And now we've just slowly been kind of recovering back. But a lot of people are trying to compare when you look at the S&P and we look at the market now. I get a lot of folks when they want to argue with me or they want to present the bearish side, say, well, what about in 2008, 2009? This is what happened. Let me first ask, do you see anything on the bank chart right here that looks anything similar to what we had in 2007, 2009? That was a financial crisis. That was bad. I mean, when you've got the likes of Bear Stearns and Lehman Brothers and, you know, a lot of the money central, those large money central banks or money center banks, those, when they are talking about, you know, maybe the whole system, it was a systemic issue. You're going to compare what we're going through right now to what we had back in 2008? Are you kidding me? Is that what you think we have, a financial crisis? I just don't see it. I mean, if you want to compare what we have here, I mean, we've got unemployment 4%, under 4%. We've got still jobs remain positive. We got interest rates near historic lows. We still got the Fed, the watchdog of the banking system, making sure that our financial system is protected with more reserves than ever before. This isn't 2008. Stop comparing what we're going through right now to 2008. Makes zero sense to me. Zero, not 0.1, zero. If you want to compare this bear market, I mean, the similarities back to 1990 were almost identical. What we're going through now versus what we went through back then. Had the Persian Gulf War, oil prices spiked, a hawkish Fed, recession. I mean, that's the period you want to look at. We've had lots of recessions during secular bull markets. So anyway, what I wanted to show you here on the banks, I didn't mean to get sidetracked there, but just reminded me of some comments that I've had coming in about how this, you know, what happened back in 2008. And therefore, you know, we're going to go back down because of something that happened one time during a financial crisis. Anyway, down here at the bottom, I want you to look at the relative strength of banks. You know, I've had some questions come in and say, well, you know, are you concerned that banks aren't leading the S&P 500? And my answer is no, because banks hardly ever lead the S&P 500. Banks are not your growers. They're very value oriented. Their earnings generally are pretty predictable until we start getting into some economic issues, until the yield is inverted, you know, and those types of things. But generally, you just want banks to go along for the ride. They're not your leaders. They're nice to have in a portfolio. They generally pay nice dividends. So for somebody who's looking for income, they'll give you some growth along with the overall market. They'll pay you a nice dividend. And that's what they're good for. If you're looking for banks to be the leaders, you know, I'm going to get a portfolio full of banks. Let's go. We're off to the races. Well, I wish you the best of luck, because that is generally not going to work out as well as getting a basket of semiconductors when the market's going higher. Semiconductors are generally going to move much, much, much faster to the upside than, say, banks. But I mean, if you look back over throughout this secular bull market, which began back in my opinion, 2013, when the S&P took out the highs from 2000 and 2007. That occurred on April 10th, 2013. Since then, look at the banks. I mean, went down a little bit in 2020 with the pandemic. Then we came back up a little bit. But I think for the most part, we've had, you know, a little bit of a drop there, a little bit of a move higher here, a little bit of a rally here. But if you look back over the last 10 years, wouldn't you say that essentially banks just go along for the ride with the S&P? That's what it looks like to me. So I just want to make sure the banks are okay. I don't care if the banks are great. They don't need to be great. They just need to be okay. Look at the relative strength of banks over the last 2 or 3 years and compare it to 2007 to 2009. Do you think this is a similar market? I'm going to just go out on a limb and say no. Now, we do have to worry a little bit in the short term anytime you have an inverted yield curve. Now, there are a lot of different definitions for how you do this calculation. A lot of folks like to look at the, actually, I think I put it 1 year in here, but it should be a 2 year. Oh, no, that was a month. I'm sorry. Look at the wrong one. I did want the 1 month. Okay, so there's your 10-year Treasury yield versus your 1 month Treasury yield. This is basically just tracking the difference between the two. Then I also did this other one over here where I did the 10-year Treasury yield versus the 2-year Treasury yield, because this is what most folks talk about when they talk about the yield, the yield spread or yield curve. You're looking at the difference between these two, the 10-year and the 2-year. And you can see right now we're negative. We went negative. We went negative back, if you want to look for a similarity to 2007, we went negative from 2000, we were dropping 2004 to 2007. That led to a lot of things, but eventually to a financial crisis. Now, don't panic, because most times when the yield curve goes negative, it does not lead to a financial crisis. That time it did. But this one has definitely gone negative. And so this is what a lot of folks are up in arms about. Now, I audited banks when I was in public accounting, and I'm much more concerned about the 10-year versus the 1 month, because I think that is a little bit more, I think it follows banks' profitability a little bit better. The very, very short term yield on the 1 month, I think, is a better use than the 2-year. And in the performance of banks versus the S&P 500, what I've done down here at the bottom is I put in a correlation. And so what I'm correlating is the direction of the difference in yields up on top here to the direction of banks relative to the S&P 500. And if you look across here, the 2000s, we had a little bit up and down. I'd say it was probably a little bit more positive than negative, but it went back and forth. But since 2010, I think you could agree that for the most part, whatever the 10-year versus minus the 2-year Treasury yield is doing, banks are generally doing that relative to the S&P. So when this is rising, this is positive correlation, that means that banks relative to the S&P would be rising. Well, we know that wasn't true. And of course, we ended up going down here in the negative territory. But over the last 10 to 12 years, we've had pretty strong positive correlation. When this yield spread is going down, market tends to go down. When the yield spread's going up, tends to go up. Now you look at 14 through 19, you say, well, the market went up. Well, remember, this is only over a 20 period, this is a weekly chart, so it's a 20-week period. So the overall trend could go in one direction while prices go in the other direction. But in the short term, 20-week periods, we tend to see quite a bit of positive correlation. Another way to look at this too, or to kind of explain this, is that Treasury yields, if you look at the 10-year Treasury yield, it tends to go in the short term the same direction as the stock market. Yet, when you look at a long-term 40-year chart, yields have been coming down for the last 40 years, and the stock market's been going up for 40 years. So it looks like they're inversely correlated. But if you look over short time periods, it's the rotation that we see in the Treasury yields and into the stock market that can influence the correlation. Anyway, that if I'm making your head spin, I apologize. That probably could be another 30 minutes discussion all by itself. But here you can see going down, and the market's been going down in 2022. So there's your positive correlation. Banks obviously going down with the overall market. But the one thing I want you to look at is over these last 10 or 12 years, look at the number of times we've gone negative into inverse correlation. I'd say maybe 10 times, roughly. I want you to look at the 10-year Treasury yield versus the 1 month Treasury yield and focus on that same thing. Since the bull market began, 2013, I mean, really, it's only been 3 or 4 times that we've gone negative. In other words, I think this is proven to be a better indicator of how banks are going to perform than using the 10-year minus the 2-year, which is widely used. I think this is a better spread to follow. And if you notice, we've been coming down, but we're still positive and starting to turn back up again. And we'll never see zero if the Fed stops raising rates or begins to slow raising rates. So 10-year, we're seeing it rise again. Depending on what the Fed does, I think eventually at some point later this year, I honestly believe Fed's going to either cut later this year, or it's going to be the early part of next year. I think they're going to start cutting because of deflationary pressures. I know we're a little bit over 9:30. I'm going to wrap this up, but I wanted to just go through this because to me, this is a better chart to use to determine how the banks are doing. And that's really when you start talking about the yield curve or the yield spread, we're really concerned about banks. Why? Well, 2/3 of our GDP is consumer spending, right? Does the consumer not borrow? I mean, I think it's pretty clear the consumer is a borrowing machine. Our companies, our US companies, grow via leverage. Many companies use, their lending capability or their borrowing capacity to help grow their businesses. When banks start seeing the squeeze in their profitability, they stop lending, or they at least really slow it down. They don't take as many risks. So that's why this becomes really important and why the yield curve is watched by so many. Because when that yield curve is dropping, banks suffer. Their profitability suffers. The long end of the curve, which drives their revenue, the short end of the curve drives their expenses. And as those two start to meet, what do you think happens to the profitability when interest revenue and interest expense start to meet? Banks struggle to make money. The economy weakens. Loan losses go up. And it's just, things start to tumble for the banks. So that's why these are important. But I would watch this chart more than the other one. All right, we're going to do combine the earnings and the 3 you must see together since the market just opened. I'll give you 3 of the companies that just reported last night after the bell, and we'll take a look at their charts, and then we'll wrap this thing up. So I'm going to start off with Intuit. Big report here. They beat $1.10 on their bottom line. Market was expecting 98 cents. And you can see big gap up. Got to get through that prior high, but that was at least a nice start. We'll see whether we can make that breakout. But that's what we're looking for here on Intuit. The next one is Advanced Auto Parts. They matched expectations. Not good enough. $3.74 was expected. That's exactly what they earned. And you can see a big move down. This is a stock. Well, yeah, there's the AD line. AD line's really strong. So if you can get it early, weakness, if it were to go back down just a little bit below this prior low, it would be a risky trade. But I might consider a little small piece to see if we get a rebound, because AD line tends to be, that indicates that the stock tends to finish in the upper half of its candle. So if it's down early, a lot of times that can be a good time to jump in. After earnings, though, it's going to be volatile, not for everybody. So you might, think about that twice before taking a position. And then the third one, how about Toll Brothers? We talked a little bit about home builders, home construction. What's Toll Brothers doing? Well, they beat 235 versus 230, but stock is down a little bit less than 3%. I'm just not seeing a whole lot here. Is this possibly a right shoulder? Maybe coming down, left shoulder, neckline, head, neckline, right shoulder, down here with the left shoulder. So potentially, but that wouldn't confirm until we move up and break out and close above about $51 or $52. So still a lot of work to do on this chart, but that's a possible pattern on Toll Brothers. Of course, going back down below 40 would negate the whole pattern altogether. All right, quick update on what the market's doing, then we'll wrap this thing up. Well, we got a little bit of red. Dow down 72, S&P down 7, NASDAQ down 24, but not a lot in terms of the opening gap. So question for me today is real selling going to kick in? And when I talk about real selling, I'm talking about from 9:30 in the morning until 4 o'clock in the afternoon, Eastern time. While the stock market is open, do prices go lower? Because I know what market makers do at the opening bell. They manipulate. I mean, I did a video on it a couple weeks ago. Go to YouTube and just search for Wall Street Thieves. Thieves, thieves, Wall Street Thieves. That should pull up my video. But I've been tracking it all year, looking at how the market's been opening, how it's trading in the morning, which I call amateur hour, and then how it trades through the balance of the day, which really gives us the best picture of what's going on in the stock market. So that's why I'm interested to see how we finish today. I want to know, is there real selling? Is there distribution taking place? Or are we just being subject to a bunch more manipulation like we were throughout much of this cyclical bear market in 2022? And I'll probably talk about this on Saturday some as well. I think this is a big, important part of what's been going on. All right, that is it for me. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live episode. That'll start at 9 a.m. So simply just go over and click on that link at 9 a.m. tomorrow. You'll be able to get that episode. And I just want to mention one last time, where does the market go from here? Big event Saturday, 10 o'clock in the morning. You do need to register. It is a free event. You're never going to see an event with this much value in it for free. I can promise you. We try to make it very educational, try to teach you a lot of the things I look at in the market, and it's free. Check it out. Anyhow, everybody have a great day. Happy trading.